18th, 2025. This is, well, overtime for whatever session this was, Ilya.
Do we even know, and does it even matter? They haven't done it.
They really haven't done anything. It's incredible to say that here and start off the show with a joke because it's the smallest intraday trading range for the NASDAQ. It's for the S&P 500 since March 28th, 2024. Nothing happened today. We're pinned. We enter this market, of course, waiting for our friend Dylan Radigan to call back into the show. He's still remote here, but will be joining us shortly. I'm in New York. Ilya's in San Francisco. We're here to take you through the rest of this hour as we wrap up the trading day. Futures market closes at 5 Eastern, 4 Central. So if you're watching on the platform Tasty Trade or the website tastylive.com, thanks for joining us. Come over to YouTube. Tell us what you think of this market. Let us know if you traded today, because not many people seem to have traded today. It's an S&P 500 that's only down by 0.03%, NASDAQ down by 0.02. I suppose the good news is the Russell hangs its hat above water, up by 0.4%, just off the highs. Elsewhere, yields, they did move up over the course of the session, although by the time we get to the end point, we are slightly off the lows. We have Dylan Radigan joining us now. Dylan, good to hear from you.
I'm a literal man on the street.
And we're going to learn what people on the street think after this show, because not much was going on today. In any event, though, gold slightly lower, silver up marginally. Bitcoin, crypto, generally speaking, comes back in. Are people out there buying the dip into 115,000? We'll find out more. Dollar bounces a bit. Trump is meeting with European leaders to talk about a potential ceasefire or peace agreement in Europe. Those headlines could be hitting the tape anytime soon. Ilya, it's the most boring day in the market since March 28th, 2024. The S&P 500 that day had a range of 20 points. Today's range is 28 points. Are we waiting for Godot, or dare I say Jerome Powell?
I mean, I think that much seems clear, because if you look at what the markets did last week, never mind today's snooze fest, they didn't do absolutely anything after that CPI data. CPI data came out, gave the markets a big push higher. The subsequent 3 days, nothing. The S&P 500 returns 0.05%, and the NASDAQ is actually down 0.56%. in the 3 days last week that CPI is not. So Monday, there's a little bit of a lead-in. Tuesday, we get the CPI number. From there, the market goes to sleep. This was a market that had all the conviction that it looked like it had after those CPI figures. It certainly didn't show up immediately after and hasn't reappeared since.
Don, you have any opinions on the state of this market here today? Stocks really don't do much of anything, but is this part of the supernova digestion?
No. I mean, let's be quite clear. It's the last 2 weeks. It's the beginning of the biggest vacation weeks of the year. I mean, I don't think you can read anything into it. It's what August looks like when there's not a catalyst. I mean, obviously things can happen in August if there's a catalyst, a big data point. Absent a big data point, I think you're just looking at August. I do think that it still sort of provides an opportunity to posture. I still think that, for instance, oil is interesting on the long side because I'm skeptical of the Trump peace plan, for instance. I'm happy to see the dollar having a little bit of life. And I think that the dollar is still a friend of those who own it. So, I mean, if anything, I think it's a chance if you sort of have things that you like, days like this and moments like this are a chance to add a little, I guess, in the context of a calm price environment. And so for me, I like the little oil position. I like the UNH thing, as I was sort of half joking with Tom and Tony during the handoff. So I think it's an opportunity to get more of the things that you like. I mean, I guess the only reason I would sort of slow myself down is all the Ilya things having to do with data and the Fed. But I mean, by any reasonable measure, barring some bizarre and insane CPI or jobs data in September, which obviously you can't rule out, but there's going to be rate cuts. So,
well, are there going to be rate cuts, Ilya? Since Thursday, we've seen that rate cut odds have fallen back fairly meaningfully. 105.7% chance for a September cut. basically 25% locked in plus a 5.7% chance of an additional one in September. We get through the start of this month and we now find ourselves seeing rate cut odds pulling back in 83% at the close today. Why is the market becoming less sure of a potential rate cut in September? And moreover, is that one of the reasons why stocks may be stuck up here?
I think that's exactly the reason why stocks are are stuck up here. I don't think it's necessarily the case that the markets are losing conviction in a September cut. I mean, as you've pointed out rightly, when you are anywhere above 55% within striking distance of a rate cut, and we are increasingly there, that rate cut occurs, or rate change, we should say. It's either cut or hike, it doesn't matter. But when we look at this now, there's about an 83% chance that we're going to get the cut in September. It's about a 50-50 toss-up for October, and by December, a second cut looks likely. So the 50 basis points that the Fed has been advocating for really since December of last year, it's in the market. And the key difference here is the level of conviction. At one point in the wake of CPI last week, the markets had the September cut at 94%. Now it's at 83%. At the same time, the market also had no likelihood, no chance that there would be no cut. The edge case was maybe a 50 basis point cut. Now that's off the table, and the possibility is that there is a standstill. That's at about 16%. So the market, I think, is just evening out. It got very hopped up on the CPI number for some strange reason last week. It really wasn't all that convincing, but the market loved it. It got very hopped up on it. Since then, we've had a kind of moderating of expectations to something more reasonable. And of course, we have major event risk on this score this week. There's the FOMC minutes, which are going to tell us whether the Fed really was in the midst of a dovish head change, as evidenced by the Waller and Bowman dissents in July. And if now that head change has occurred, will be found out on Friday when Powell speaks at Jackson Hole. So you get a kind of 1-2 step here. You get a sense of whether the Fed is already getting there in July, which would be encouraging for the markets, where they would go, oh, well, if only the data is neutral relative to this, then we're going there. And then you get confirmation or not on Friday. And the data we got last week, and perhaps this is the absence of follow-through epitomized here, the PPI numbers were not encouraging at all. And then the consumer confidence numbers on Friday were not encouraging at all. Both of them said that tariff-based inflation is coming to a store near you. The PPI numbers told you the pass-on from wholesale to consumers is well underway. And consumers, being clever, figured it out because the consumer confidence numbers had a pickup in inflation expectations and a parallel decline in sentiment. That's not what you want to see. That's not what the Fed wants to see. Those are not the ingredients for an expansively dovish Fed, which is what the markets want. They and the Fed are still about 50 basis points apart. So when you look at all of this together and you say, well, what are the markets actually priced for? The 50 basis points this year is a given. The issue is next year. And for next year, the markets are at 70 basis points and the Fed's at 25. So if the minutes and the Jackson Hole speech don't go the way of these expectations, well, then risk looks expensive. And I think it's that simple.
Dylan, do you have any strong feelings about what Fed Chair Powell might do in Jackson Hole this week? Otherwise, I think we should probably go into the more interesting topical news of the day as it pertains to tech stocks.
I mean, I don't know that I mean, I think that Powell is going to basically do as little as possible. I think it's in his interest not to tip his hand at this point. Like, I think he'll go out of his way to say a lot of words that mean nothing. Like, what incentive does he have to basically try to alter the expectations at this time?
And then what happens to stock markets?
Well, I think that's the important point, Ilya, that you and I were drawing out earlier today on Futures Power Hour.
Dylan's absolutely right, by the way.
Insofar as when we take a look at how, well, he has to obfuscate. He has to obfuscate because there's still a few data prints due out ahead of this next Fed meeting on September 17th. And so if you get a PCE report Friday morning that has 0.5, 0.6% month over month, how can Powell come in and say, no, it's transitory again. Trust me, this time. We're going to cut in September. It just too much liability there from a credibility standpoint. So given how the market's been reacting to treasury yields, where treasury yields up, stocks pulling back in a little bit, maybe that's a reason for a setback later this week. But the incentive structure isn't for Powell to stick his neck out and make any grand claim that we have inflation defeated, Dylan.
Exactly. And so I just feel like every incentive for him is to say as little as possible, to not add any new information to the situation, basically.
As John Rockefeller said, write nothing down, say less. Dylan, I want to talk about our problem that we have with one of our heavyweights here in the NASDAQ right now, though, because if you've been following the news over the weekend, NASDAQ has a 6.24% weighting for Meta right now. Meta is seeing some fairly bad headlines related to what their chatbots are talking about with kids. It's off 2.27% today. It fell back even more. It hit a low in today's session of 780.82. Is this the new risk to your supernova thesis, that these AI bots are actually going to cause societal harm, particularly for younger members? And as we reconsider the glories of the supernova, we have these externalities on the downside that need to be addressed before they spiral?
I think it's probably the most important question. I mean, let's just sort of look at the sort of base assumptions, if you will. One, no one and nothing will stop AI. Two, I believe it's 100% chance there's going to be AI for, unstoppable. I also think there's a 100% chance that catastrophic things occur as a result. And so I think the question becomes, what is the consequence of widespread AI and widespread social liabilities from AI? Not just in terms of the sort of terrible advice that it will yield to young people relative to their life decision making. I mean, the biggest issue with AI, having been using it more and more, I use the GPT-5 with the subscription on my phone, so to be clear when I say AI. My experience is that it tends to basically validate whatever you say. So if you say, is it a good idea to use a social media strategy to launch a coffee company, it'll say yes, and here's why. And then maybe say, is it a bad idea to launch a coffee company? And it'll say, it tends to sort of agree with whatever it's fed, which means it basically becomes an amplifier to whatever the mood of the prompt is, because mood is the emotions are transient like the weather, it tends to make me think that part of the liability of AI is that it amplifies negative inputs and validates negative inputs, which sounds like my words, but some interpretation of what they're talking about with the meta feedback loop. I mean, I guess you could have a social backlash. You will have a social backlash against it, obviously. But I mean, there's a social backlash against all technology, and it hasn't stopped technology.
Right.
I guess, in other words, I don't look at the risk of social backlash to AI as a meaningful investment risk. If anything, I would use it as an entry point from a trading standpoint. Like if there are sell-offs based on negative AI headlines, I would buy the stocks. Cynically.
Okay, evil always wins is one perspective, Ilya.
Well, and every technology has two sides, because every technology is a reflection of the people that then use that technology to do what they're going to do. I mean, are we going to get mad at the radio because the radio has both informed people and disseminated some of the vilest, terrible, violence inciting nonsense in history, and enabled it? No. Are we going to get mad at film? Are we going to get mad at railroads because they shortened travel times, or airplanes for that matter, because they shortened travel times, but they also transport tanks and bombs? No. So it's one of those things, as ever, that is a mirror image of the user. Of course it is. Why would it be anything else? Dylan makes a great point that this thing really ought to have some kind of a anchoring in reality. It ought to not just spit back subjectivity, but some semblance of real life. But if you get away from asking it opinions and start asking it, hey, can you execute XYZ task for me? Well, then that becomes just a tool, and a tool that essentially reduces how much friction there is between ideation and execution. And as more people are empowered to get to execution from ideation, whereas before maybe they didn't have the technical skills, maybe they didn't have the time. If somebody has had the greatest of all ideas about some movie script that nobody has written, but they have a day job and no time to write it, and now that they can dictate it to this thing, and this thing can shorten the time to execution, or somebody had an app idea and this thing can code it for them if it is explained conceptually by somebody that doesn't have coding skill. This is game changing. But at the same time, it's gonna have negative externalities, because the people, those people that have good ideas will be enabled, but those people that have bad ideas, damaging ideas, dangerous ideas, violent ideas, they will also be enabled. So as anything else, it will have upside and downside.
Yeah, you guys need to prompt your GPT, Claude. I always tell it whenever they release a new model, I say, always respond formally, cite real sources, do not infer or guess about anything.
Yeah.
As a meta system prompt.
You add that to your prompt?
Every time they update the model, that's the first thing I send into the model. And it updates its memory.
A difference? So you get an improved performance?
When I don't log in versus logging in, I'll ask a question, and when I'm not logged in, it's like, great question. You're really inquisitive. So it's like, no, it's like, get off, please.
Yeah.
Okay.
Stop it, Skynet.
It's like you, it's like you talking to Sosnoff.
Yeah. Well, and then, right. So I've had to do that because I don't want it guessing, and I don't want to be like double check yourself. So you do have to do some meta system prompting, but I also do the contextual prompting, and like, let's role play. You're an assistant working at such and such. I need you to find these 3 things for me. This would be in your realm of knowledge, how to figure this out. So go figure it out. But I think that, I always ask it to give me real sources, no fluff. Don't make anything up. Otherwise, it's just so back-patty. And there's a lot of creepy subreddits out there, Dylan.
Well, can I just say the most interesting thing but before you get to that, the most interesting thing that I saw, or that I read, I should say, regarding AI in general, is that the entire apparatus, whatever that means, every possible piece of the apparatus needs to be encoded with maternal instincts. And if you don't encode it with maternal instincts, that it's going to end up leading to catastrophe. It sounds simplistic, but I think it's a reasonable. Like, you're going to need a central organizing principle, and I can't think of a better central organizing principle than encoded with maternal instincts.
There is a great HBO show out there called Raised by Wolves that explores the idea of an artificial intelligence with maternal instinct. It's actually specifically on this subject. The archetype of the devouring mother is not an archetype for no reason. And so
Hamsters.
we just want to be careful before
Polar
we have
bears.
one-size-fits-all solutions to things.
Scorpions. They all eat their young.
I mean, just if you'd like a great non-sci-fi example,
tiger sharks.
Watch The Sopranos. That archetype is on display readily.
Okay. All
Let's say
right.
healthy maternal instincts. Maternal instincts
Yes,
that are
healthy
in the
maternal
interest of
instincts.
preserving the young. How about that?
Yes.
Yeah, like a do no harm type of central thesis. I know it makes a good deal of sense superficially. I'm curious, though, what the research says about it. Why, if you don't program that, it automatically starts leaning into other outcomes. I suppose we could look at Grok.
I think it's because it does confirmation of whatever it's getting, and a certain percentage of the inputs are going to have negative, and some are going to, and a small percentage are going to have extremely negative bias on the inbound side, and I think AI is inclined to agree with whatever it gets.
All right, so Dylan, let's switch topics here. We have oil prices moving up today after the Trump-Putin summit over the weekend. You're always one to look for an opportunity to sell a geopolitical rally, although I doubt we would call it this. Cool images and videos aside of pixels missing from the sky with the B-2 bombers flying over the Putin-Trump meeting. What have we accomplished here? Are we actually looking at an off-ramp? I know they're having a meeting right now, but should we be prepared for a much bigger move in oil this week because of this summit or whatever they're doing in D.C. today, Mr. Redigan?
I mean, I kind of said my piece on when we spoke last Thursday. I don't see any relevance to the outcome beyond whatever Putin wants to do. I believe the world has zero leverage. And so if anything, I think Putin is just trying to take advantage of the West and Trump specifically, and his interest in sort of being seen as a deal maker to take the meeting. But I just don't see the only reason Putin is going to bring this to a conclusion is because it's in his interest. Because I believe, as I said on Thursday, I don't see how anybody has any leverage, including the United States.
I agree. I mean, I think for Putin, this is survival. And if it looks at all like he lost this thing, then the wolf pack that is the Kremlin will eat him. I think he understands that. I think he understands that he needs to bring home something that can be reasonably sold as worthy of the sacrifice. Russian people are notoriously ready to sacrifice if they can be made to believe that it is glorious and patriotic and worthwhile. And if that cannot be sold after the rhetorical hole that Russian propaganda has already dug itself into, then it's not going to end. So for him, it's, well, run it up and either it goes my way or I go down with the ship. Not a big difference for him. So I think Dylan's absolutely right. The only real question is here, at what point does it become too costly to continue? So to have this kind of group all together, basically that Zelensky decided that this time he's not going to get ambushed by J.D. Vance. This time he's going to bring the whole of the EU with him. I think that makes a big difference here. We'll see what that means. And he wore a suit. We'll see what that means. He's not kidding, clearly.
No, and he actually had a really good comment when the reporter who asked him about the suit last time questioned him today. He pointed out the reporter was actually wearing the same exact suit as last time. So Zelensky came with a little bit of a punchier attitude. Him and Trump looked like they were getting along, which I
Good.
don't know if that means anything, but it looks like it's a headline here that's going to move the market at some point, either later today or tomorrow when these meetings conclude. Does it mean anything for oil though? Up 1.11% here. If we get a bounce back, does it mean anything? Ilya, we've been fairly stayed quiet on this because there's been nothing to do except to watch it trade sideways. And I think that's still the right approach right now. If you're trading it sideways on a long enough basis, whatever headline comes out this week, subsumed in a few days, 3-4 days, one might imagine. But oil at a 27.2 IVR, a little bit more juice than we're seeing in our equity market here. I do want to keep it with commodities, though, as we get through that halfway point of today's programming. Ilya, we have gold that's chopping around sideways. It's off by 0.12%. I saw a really interesting number here today, which was what allocation do fund managers have right now in their portfolio? 61% of fund managers say that they have only between 0 and 2%, 0 to 2% of their clients' funds allocated to gold. Does that surprise you, given how much gold has run up so far this year? Does that tell you that this is still very much a market that's being driven by central banks and not necessarily by your longer term stockholders?
It seems like it. And I mean, let's remember, where is the top of this range? I mean, we're talking just in the wake of Liberation Day. Gold has basically gone nowhere since that time. So we had a big run up, obviously, on the back of all of those concerns. And gold has been listless since. So it seems like the essence of the run up before was this idea that maybe there's a genuine sovereign risk in the US. Once we got off that idea and it became clear that even this administration is not so reckless as to flirt with really opening up a sovereign risk type of a crisis for the US, which would be completely self-inflicted if ever there was a country in the current environment that does not have meaningful sovereign risk, it is the US. So once it became clear that that was not the case, we got into this interesting mix where on the one hand, there is yields, and on the other hand, there is the dollar. And the dollar has stopped falling, and yields are not exactly cratering here. In fact, if we look at something like ZB, it is basically the same range as what we see in gold. It is just sideways, waiting for things to happen. So I think momentum has meaningfully exited this market, which is why I've traded it mainly from the vol contraction perspective. Now I think looking at this week and onward, as we get more clarity on the Fed and you get some sort of conviction on yields and the dollar, you have an opportunity for this to get a little bit cleaner. It seems to be coiling up for a breakout of some kind.
Dylan, are there any concerns about what happens on the other side of this deal that we might mark up with Russia? Do we need to think about where the money flows after the sanctions come to an end? UAE, the ETF that we've been talking about for some time as a potential destination, started the year closer to $16.50. It's now $19.96 on today's close. Is that really the trade? We're looking for opportunity, not just tending the crops right now. Where does the Russian money go?
I mean, I love this sort of discussion. Obviously, I think Dubai is the number one place. I just don't know how tradable it really is. I don't know how much, I just don't know. I mean, I just think that the European, I feel like they will do everything they can to try to make sure that this doesn't happen.
Why? Because if that's the case, then that's a real problem for the
Europeans
euro.
don't want to lose the money. No, I'm saying I think capital flight from Europe is something that they will try to prevent. How, I don't know.
Well, one big reason that capital flight from Europe may be a very different sounding narrative next year is this very big defense spending initiative that is likely to lift a lot of boats in Europe next year. In fact, if we look at the sort of landscape for, let's say, ECB rate cuts next year, we can see that there's, at this point, no rate cuts on the menu at all for the ECB next year. In fact, there is a sort of periodic flirtation, if you will, with the possibility that the ECB might actually need to hike rates next year. Going back to March, we were even looking at about a slightly better than 50% chance that there'd be a hike. That's since come off. Now it's basically standstill. But if we get all of this money, 800 billion that just the EU has earmarked for defense spending, and not all of it is already accounted for, only about 100 to 200 billion has actually been made official through policy. But if that's what we're talking about, if we're approaching €1 trillion spent, I mean, that's going to be a ton of money that's going to be sloshing around in European markets next year.
And how serious is it that all of these European officials are over here in the US? I can't remember the last time that it was outside of like a UN gathering that all of Europe's brain trusts absconded on the US soil. This is a big deal.
Mm-hmm.
How much of a turning point is this? Are we understating the moment right now for what this week means, even though it's a vacation week for most people?
I'm just such a Trump skeptic because he's such a fan of theater without consequence. I understand superficially why this, like if this was a normal administration, I would think that this is a much more substantial situation. But I feel like Trump loves the attention and loves the theatrics, but delivers a lot less. Like he's a showman, and he has the power to do this and the power to create a show. But I mean, so I tend to be skeptical of the whole thing. I mean, the less cynical interpretation would suggest that this is a setup for a peace deal with Russia, which would then sort of bring back the capital flight discussion in Europe. Will they, won't they, can they, can't they? And it'll bring up the sort of future of oil prices relative to the potential of bringing Russian oil back into the European theater. But it's either a prelude to a peace deal or it's a meaningless show.
Prelude to a peace deal or a meaningless show. Hey, I got a comment earlier.
I think it's Putin's decision, not theirs.
Well, of course it's Putin's decision. He's the guy who started the war.
Like, what are we doing here?
Ilya, I did see a question earlier if I saw Torsten Slok's latest chart from Apollo about his 1990s analogy, because we've brought up the 1998 idea here on the show previously. This was from his blog over the weekend. I figured we'd share it here today. We're about right here right now. If this is the 1998 analogy, we're going into 1999 soon. I know that 1929 likes to make its way around the market when things are looking scary. I like to pull out these analogies time and again because they make me feel nice and warm when I'm trading on the long side. Why shouldn't traders look at this and start buying $7,000 strike calls in the S&P 500?
Because it doesn't mean anything. I mean, there's absolutely nothing that says you have to look this way or that. And just because you've had some symmetry up to here in no way says you are necessarily going to have symmetry from here. It's just such a flimsy argument for me to think that one other time you had a chart that has looked similar. You're comparing one stretch of time to another stretch of time and saying, well, don't these look similar? Yeah, of course they do. But if ever there was a case of squint hard enough, change the scales, you'll notice there's two different scales on this chart. Squint hard enough, change the scales, and forget that correlation is not causation. And sure, you can feel better, but who cares? This is to presume that this works would be to treat the market as though it is some sort of a magical machine where you have almost like punch cards of scenarios. And you go, oh, well, time for card X. Not card Y? No, card X. Load it up. This will be good for the next 7 years. Obviously, the world doesn't work that way. So if ever there was a truly meaningless thing, this is it.
Here's a more interesting chart then. Also comes from a similar deck. FedEx stock prices starting to go lower, which tend to have a relationship with global trade. Another one of these charts that he was shared last week, just running through some of the stuff that's publicly available here. So you can go to his blog to find these. Let's go to this one here as well. Apollo Academy, container ship departures from China to the US, falling back down to levels that we saw when the trade war started picking up. And total
shipping. In other words, the front running has been spent.
The front running has been spent.
Yeah.
The front running has been spent is the takeaway that you see here. So regardless of
second quarter GDP numbers would tell you exactly the same thing.
Yeah, and that's why, Dylan, I'm looking at what's happening in oil and putting this all together, and we have a 27.2 IVR. And so if we get a headline that gives you a rise in oil prices here, it's got to be something to fade, because the backdrop with which it would be occurring is one of a weakening global economy still. Geopolitics have been a fruit that we've been able to harvest a number of times this year.
I mean, I just, the thing with these is like the risk, where I've gotten caught on a couple of these, I've had a decent amount of success with a handful of these, as we've talked about, but where I've gotten caught on a couple of these is because of my relative confidence that it's a good trade to sort of short any geopolitical oil spike. There's a risk of getting it. It can go up for a few days or even a week or two. Like you could come out of this super summit with no deal, and the interpretation could be endless war, and you could get more juice before you get short. So I guess it's one of those things where I guess a half a position. I just would be it's because it's only just got going. It's only a few days old. That's my only caution. For sure, I think it's a short, because you got to your point. It's a slowing economy and it's a geopolitical spike.
I agree with that assessment. I agree with that assessment completely. I think this is not enough of a geopolitical spike to fade, but because I think we are of a general consensus, at least here, that this war is not ending but for Putin wanting it to end, and he does not have the incentive structure to do that yet. Hopefully what they're talking about amongst the leadership of Europe, Ukraine, and the U.S., amazingly all in one spot here, is how to compel him to see the calculus differently. But short of that, this thing is not going to end. And he's going to continue this to the last Russian. So with that in mind, there could be a much bigger disappointment spike here to then fade than anything we've seen so far. It's just too early. The risk reward is off. If instead the market decided, you know what, we're just at status quo and we're going to slowly move the front back and forth by an inch here, an inch there around eastern Ukraine for however long, for an unspecified amount of time, then growth becomes the concern. Jackson Hole and the FOMC minutes are relevant in that sense, and probably Jackson Hole more so. And if you get a break, okay, then you short. But in the meantime, there's not enough geopolitical fervor here to want to be a skeptic.
There's enough to be a skeptic. The dollar bouncing back today, I think, says enough, and the euro being one of the weaker currencies on the board says enough unto itself. As far as the Fed pricing goes, putting this all together, the war is going to go on. The U.S. is going to provide less help to Europe. It's greater financial strain on Europe. It's difficult for me to think that this is a path forward of anything good for the euro, Ilya, because you get into a situation where they become the primary financiers of future defense of Ukraine without, maybe there's a U.S. security involvement, but that's as long as the bullets don't fly. Ukraine's not getting into NATO as long as Donald Trump is president. So it's stronger dollar. Maybe that becomes a headwind for stocks here. Second half of the month typically is a little bit more of a rough time for the equity market. Although if you've been following seasonality, which has produced a 0.07% gain on average for the S&P, we're up 1.4% month to date so far, give or take. If you've been looking at volatility is up 70% of the time over the past decade in the month of August. Not this month, off about 1.5. So who's to say that we're following any sort of normal glide path here? Dylan, you mentioned that is the second half of the month. It's one of the quieter weeks of the month. Can you explain why that matters from a market structure perspective here? I have my views on it. Ilya has his as well. But as someone who's been in the market, involved at the margins as a journalist for a number of years, what's different about late August? And how do you think retail traders should approach the market a little bit differently?
I mean, late August is second only to the Christmas week for just the smallest number of participants. There's just the smallest number of human beings that are actively on financial trading screens, institutional or retail. And the only week that is, or weeks that are slower, is the Christmas New Year's weeks, or really, let's say December 23rd to January 2nd or something like that is probably the slowest. But outside of that, this is as slow as it gets, which simply means that on the one hand, you can actually get bigger price action if there are news triggers. So like if there was a Russian peace deal, you might get actually bigger price action because the markets are shallower, and so it's easier for prices to move. And absent real triggers, whether it's a Powell says something crazy, the market could go hog wild just because of the relative thinness. And on the other hand, absent a trigger, whether it's an economic event or whether it's a geopolitical event, it's more likely to behave the way that it did today. So it's either going to be super quiet, or if you get a trigger, you're going to get a bigger heater. And if you get a big heater, especially to the downside, it's probably a great entry point because it's a less reflective price. The price action in general has less integrity, I guess I would say.
Oh yeah, do you change your approach at all for these final 2 weeks?
Your best case scenario, what's that? Your best case scenario is that you do get some sort of negative trigger and you get a big sell-off and you can buy it.
Ilya, do you change your trading style for the final 2 weeks of August as you would around, say, the holidays in December?
Not really, no. I let the price action decide for me and dictate how things go, because the markets can absolutely be listless during this period, or the low participation and the low liquidity can actually amplify volatility and make for bigger swings. And so I think really the question is, do the markets get something of conviction? And is that something of conviction overlaid with thin liquidity give you a bigger move? Or do they not get something of conviction and then there is a listless drift for lack of participation? I don't think that there is that listless of a drift on the menu after Jackson Hole this week, because clearly, if you look at what CPI wrought last week and the standstill thereafter, the markets are asleep but for Fed news. That's what they care about. That's what matters here. Because in the immediate crosshairs is the cost of money itself. Before you get to there's this risk and that's happening and this is happening and maybe AI is overcooked and maybe it's not overcooked and maybe Russia and Ukraine can come to some sort of an agreement and maybe Israel and Hamas can come to some sort of an agreement now that the entirety of the Arab League has called on Hamas to disarm and leave Gaza. Maybe finally there is a breakthrough in that theater now that Hamas has been neutered to such an extent that over the weekend in Israel, the estimates are wild, but the amount of protesting the government to end this war, unprecedented, even relative to what was happening before, and even relative to the massive protests that were happening when before October 7th, the administration was trying to change the standing of the Supreme Court, and the population wasn't having that. So maybe we're finally getting to something there. All of those things aside, though, none of them matter more than the market's perception of, is money too expensive to be put at risk, or is it going to become easier to put money at risk because the Fed will make the money cheaper? And so it will be easier to digest all of these risks and to have positive disposition because, to Dylan's point, the AI snowball will continue to roll. Or are we getting to a place where the money is too expensive to make the risk make sense? And that's solely a Fed question. So I think it'll be very, very interesting to see what happens this week. But clearly the markets demonstrated last week, when it's Fed relevant, they move. Everything else, they can't be bothered.
Can
I share with you guys one of my favorite charts that I've covered?
Question, Chris. I mean, how do you think that this late August effect is it relevant in any way to you?
I do think it's relevant. I think that if you're trading in complacent markets, that, you know, if these are frothy, again, CTA positioning is still at the 100th percentile. So trend followers are loaded to the gills. You can't really make that case right now for the futures market, though, because the CFTC cut report shows that traders have become more net short over the past few weeks to the highest level that they've been at all year, at least since the depths of April. I mean, Ilya, it's hard to make the case that everyone's in one side of the boat. So taking that aside,
yeah,
if you're going to be trading, you're trading small, you're trading a little bit thinner, you're not getting loaded up. If you're going to be bullish, you have to be willing to cut it, because if the thing goes south, it could go south quickly.
Yeah.
But the market still favors upside in a low volume, listless technical drift type of situation. So I'm still hanging on long in the short term until I get bucked off this Bronco. I can't overthink it. Overthinking it's been very harmful this month.
It's dipped through intraday range support today on the 4-hour, on the 8-hour. And so I've nibbled a little bit again on the short side, but as ever, tons of duration, 60 days this time. Small, risk defined. We'll see. I mean, the risk reward, because vol is so cheap, was amazing, especially on the S&P. We're talking something like 3-1. Not as rich on the NASDAQ, maybe about 2-1 there. So the options pricing itself is telling you it's an asymmetric opportunity. If you set it up with enough duration and in small enough size. I'm doing it in the ETFs to keep things very risk contained, using the Qs and SPY rather than ES and NQ. Russell, I don't think is there yet, but I've nibbled a little. Let's see.
Ilya, I'm thinking about the market move through the end of this week. This is perhaps the opportunity. 62.73 points priced in through the close on Friday. That would effectively mean that this is a market that could go back down to what, 6,400 or maybe break above 6,500 with the FOMC minutes Wednesday, with Fed Chair Powell's speech Friday, the PCE report, and the fact that this is the week that it is. I don't know if this is the week that I fade vol. It already seems pretty tight. And again, today was the tightest range that we had in the market since March 28th,
Vol is
2024. It's cheap. The ranges are narrow. I think that plus or minus a 1% move is not out of the question and something that we should absolutely be thinking about and consider by Friday's close. So do I want to fade this here and say that we're going to be pinned at 64.70 by weekend? No, that is not something I want to do. But you know what, Ilya? Overtime is out of time. You hear that, Dylan? You can hopefully be on video tomorrow.
Boys.
I missed that face. I missed that face.
You're gonna get it whether you like it or not. I can't wait to see you guys.
Excellent. Well, we'll be back tomorrow. Don't worry. With that, overtime's out of time. We'll be back tomorrow, same time, same place, 4 Eastern, 3 Central. Always after last call, Monday through Thursdays here on Tasty Live. So for Ilya Spivak in San Francisco, Dylan Radigan somewhere. I've been Chris Vecchio in New York. Good luck trading. Up next, after a brief break, more Tasty Live, Macro Money with Ilya. See you there.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop, so why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
My most controversial market opinion is it's probably more political.
What's your most controversial market opinion right now?
My most controversial market opinion is that I shouldn't be following Mike and Nick. Just kidding. Love you guys so much.
The hottest take of this market? I gotta think about that. I don't know. I do like to trade the leverage, but that's not controversial. I don't know what controversy means these days. Like, I don't know. I'm sitting on cash. Like, I'm still sitting on a lot of cash, and I think that's generally seen as like frowned upon, but like I'm still doing it. I know market's been bouncing back up. I know things have been looking clear, but no, trust issues.
I honestly don't know if I have one. I'll say the fact that I like to trade earnings or direction as opposed to vol.
My most controversial market opinion is it's probably more political than it is anything else. So, I would say that, unlike others, I think the current political environment in this country is dangerous for the long term.
Did the markets even open today? Absolutely listless across Wall Street as we finish the first day of the week here, but we do have an action-packed week ahead. Not so much in terms of data, but certainly in terms of Fed watching. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to do here is take a look at what the markets did last week by way of stage setting to see what might be coming up next, and then take a look at the risk from the event calendar immediately in front of us and try to get a sense for what all of it means going forward. Because we do have, against all odds, despite a relatively thin offering on that calendar, plenty of risk to contend with. So let's consider first how the markets did last week. We can see a modest increase for the S&P 500, a modest increase for the NASDAQ, things slowing down significantly from the prior week, just 0.4% added for the NASDAQ, 0.9% for the S&P. A kind of a mixed bag on yields. On the front end of the curve, things relatively steady. It looks like Fed policy expectations looking mostly anchored here. At the long end, slight uptick on yields, but not a whole lot to write home about, 0.9% gain. Crude oil continues to do its own thing, down 1.7% last week after a 5.1% drop. There's, of course, lots of back and forth here. We had a meeting between U.S. President Trump and Russian President Vladimir Putin in Alaska. Now the president is meeting. President Trump is meeting with the leaders of the European Union alongside Ukrainian President Volodymyr Zelensky. So we'll see how that goes. For its part, crude oil is basically pinned to the center line of the range that has basically contained all of what's going on, geopolitical crises in the Middle East and Russia inclusive, since basically mid-September of last year. That range roughly between about $74 a barrel and $54 a barrel on the WTI contract. We're pinned right there, and we're not going very far. So despite these oscillations here, not a whole lot that's going on. Gold price is down a little bit last week, in by 3.1%, but again, that stuck in a range, and in fact has been in an increasingly narrow range since late April, once the dust settled on Liberation Day. So we're looking on a market here that wiggled a little bit, but ultimately isn't very much changed this way or that. Euro a little bit higher, yen a little bit higher last week, so very modest pullback in the US dollar. Bitcoin basically idle. So really all the action last week seems to happen here on the equities side, and by slight extension in the bonds. And what's particularly interesting about this is it all basically happens on a single day. So consider this is the S&P 500 here, the continuous contract for S&P 500 futures, and just do the count back here 5 days. Here's last week. Nothing happens Monday. We get a US CPI report that the markets get all kinds of jazzed up about. And then for 3 days, nothing. Standstill. As a matter of fact, the S&P 500 ends last week. Across these 3 days, this side, across these 3 days, there is absolutely no movement. 0.05% is the net change across these days. So if not for this CPI report, the markets did nothing last week. Moreover, in the wake of this CPI report, they found no fuel for follow-on conviction. It's a similar story for the NASDAQ here. Here's the CPI report right there. And actually, in the NASDAQ's case, over the subsequent 3 days, it managed to inch down a little bit, off 0.56%. So it moderated this rally a little bit. But again, no conviction. So what was it in that CPI report that was so eye-catching, and why did it fail to give the markets anything but a single day's worth of support? Well, we can see here that the inflation numbers came in refreshingly, quote unquote, normal, 2.7%. So inflation flat from one month to the next, from June to July. The core number ticked up from 2.9 to 3.1, a little bit of a tarnishing on the overall story, but the market seemed to be relatively okay with that. More importantly, the expectation here was for 2.8%, so ostensibly this came in a touch lighter than expected. And the markets took that to mean that the Fed is going to be ready to cut rates. Most inflation still stuck in services. The inflation from the goods side still relatively modest, though rising. And perhaps this is why we ended up without follow-on conviction. The markets loved what they saw at first glance. But then, of course, we see that a quarter of a percentage point almost was added from the goods side. And indeed, if we take a look at the change month on month in contribution to overall CPI, we can see that while most inflation, of course, remains on the services side, it's also stalling, and as of July, even inching down by a little bit. Whereas the thrust from the goods side for a second consecutive month looks relatively potent. In fact, if we disaggregate inflation here into core goods, core services, and shelter, the main components, we can see here that services inflation actually cooled from June into July, whereas goods inflation quickened. Moreover, the year-on-year pace of core goods inflation has now increased to the highest in 2 years. Whereas for the service side of the story, we certainly have been inching higher, but we're only the highest we've been since December of last year. So a much more modest sort of situation here. And of course, for shelter, the trend speaks for itself, even though in July, this marked a little bit of an uptick. So we can see here that goods-based inflation is inching its way into these numbers, giving us exactly the kind of thing that the Fed is concerned about. That is to say, tariffs being at the same time a pushback on growth and a push up on inflation, which of course complicates policymaking. The pushback on growth would demand rate cuts. The inflation would demand, at the very least, not cutting rates, if not raising them. And so the Fed continues to sit on its hands, to everybody's consternation. Now, we can see that in the wake of those CPI numbers, through these few days of digestion, we still are looking at the likelihood of a September rate cut as overwhelming by historical standards. Generally speaking, when you're meaningfully above 55, 60%, the Fed almost always, if not always, delivers on those expectations. The question is, how far away are you from, let's say, 55% on the eve of a meeting, or let's say a week before a meeting? We're a little bit further away from that here. The next Fed meeting is September 17th, so we're a month away here. So lots might still change, but this still looks fairly convincing at 83% and about 17% chance for a hold. What's eye-catching, of course, is that in the wake of CPI, we were looking at 94% chance of a cut. This, that is a hold, had a 0% chance. And there was about a 6% chance that we'd get a jumbo 50 basis point cut. Obviously, in the subsequent 3 days, 4 days, things have changed significantly, and the markets have come off that dovish extreme. Part of that, surely, is a deeper thought about what we've just talked about, the appearance now, tepid though it is, of core goods inflation, a sign that the tariffs are making themselves known, starting to show up in the numbers. But where it really presented itself with much more conviction was the PPI report, the producer price index numbers that followed the CPI data. We can see here there is a dramatic month-on-month jump. In fact, the largest one since back here in 2022, which is, of course, the meat of the post-COVID inflation scare. And what we find when we disaggregate this a little bit, here is the jump for final demand, that is wholesale inflation for goods that are ready to be put on shelves, final wholesale, as it were. And here we have the biggest increase in the margins component for wholesalers. This services component, the trade services component, measures wholesalers' margins. And what we see is a massive expansion in their margins after a fairly soggy showing earlier. In fact, this was the largest one, again, since back here in early 2022. Even more eye-catching here, going earlier in the supply chain, was this jump in margins at the intermediate demand level. This is early in the supply chain, before you get closer to retail and closer to consumers. This is just after the goods that we're talking about, and even inputs into final goods that haven't been finalized yet. This is as close as you can look, for the most part, to margins for wholesalers near where tariffs are assessed. This is the beginning of the US-based supply chain. And here you can see that earlier in the year, there was a move by wholesalers at this part of the supply chain to eat the inflation. So you see this massive deterioration in their margins here in shock of shocks, April. And you find that they're basically looking at the uncertainty around the tariffs and saying, look, we're not going to pass on these extra costs to wholesalers downwind, and certainly not to consumers, because we don't want to destroy demand. We don't want to increase prices and drive everybody home, because we don't know what this policy is going to do. We don't know exactly the scope of the issue. So we're going to eat it into margins. We're going to take on the burden of these extra costs, and we'll see what happens. Well, now it looks like we've seen what happens, because we can see that the costs are being passed on here. The margin expansion suggests that faced with higher costs, these wholesalers have started to pass them downwind. We see that here. And of course, that suggests that whatever we saw here is just the beginning. We are ostensibly just warming up there. And there's quite a bit more to come if this pass along is going to continue, which is perhaps why the markets looked at this and said, wait a minute, hang on. This is not necessarily everything there is to see. There is some degree of smoke and mirrors in this data still. And of course, the biggest issue here comes down to consumption. If in fact we've seen that so far things have been relatively well anchored and the economy has held up reasonably all right, and so perhaps it was tempting to say, well, these tariffs are not a big deal. It's difficult to make that case when you see that the costs of the tariffs were being insulated away from consumers. And even with that, as well as, of course, another barrier to inflation surging, this front running of the tariffs in the first quarter through the restocking of inventories, we still have the weakest consumption the weakest contribution from consumption to overall GDP in the first 6 months of this year since the first 6 months of 2020, which was, of course, the COVID recession. Now, you can see here, this is contributions to GDP. Imports are subtracted from GDP. So when they grow, that is a negative contribution. And when they fall, it's a positive contribution. So you can see in the first quarter here, imports surged, which was a big change in GDP, where we had a significant pull down from essentially companies front running the tariffs to stock up inventories to then sell out of inventory and not out of post-tariff expensive goods. We also saw, and this has a breakdown of the investment component here into fixed investment and change in inventory. You can see that residential investment is essentially non-existent on here. Non-residential investment is a sliver. The biggest surge here for the overall investment component is this change in inventories. It's all of these it's all these imports going into warehouses. Now look at what happened in the second quarter. You can see that the defense mechanism here against tariff costs is unraveling. Imports are a positive contribution, which is to say that they're falling. Inventories are a negative contribution, which is to say they are being depleted. So the front running of the tariffs is spent. It's over. And so instead, what you're looking at is wholesalers passing on inflation costs and back inventory of goods at a pre-tariff structure for its prices. That's dwindling. And so, not surprisingly, there is the possibility here that higher inflation will crimp consumption, and the starting point before that bites is already the weakest consumption since the COVID recession. So not surprisingly, the markets want these rate cuts very much. The threat here is acute. Europe is still at standstill. China is still at standstill. If the US falters, the global economy is without its only operating engine. So, when we look at then the consumer confidence numbers that we end up seeing on Friday, it is no surprise that consumers were savvy. They saw the inflation reappearing. They saw the pass-through occurring. And so sentiment deteriorates. In particular, the assessment of the current situation sees a meaningful decline, overall sentiment down, and that's happening against the backdrop of inflation expectations rebounding. We're back to 4.9% on the one-year inflation outlook. And it is with that in mind that this week becomes all about whether the Fed is actually going to deliver on these rate cuts. Now, as it stands, the markets and the Fed are basically of one mind for the outlook on this year. The markets have 47 basis points. When the Fed issued their last projection in June, that's what they had. The current median is 4.4, down to 3.9 is 50 basis points. The disparity occurs for next year, where the markets have 70 basis points. That's most of the way to 3 rate cuts. Whereas the Fed, from 3.9 to 3.6, has a single 25 basis point cut. And this is where things get interesting. The first major touch point this week, minutes from July's FOMC meeting. In that meeting, we had something of a moderating flavor to what the Fed was saying. It took back this idea that uncertainty about the economic outlook has diminished. It thought maybe it did in June, and then in July it promptly reassessed. We still see a relatively steady statement thereafter, although we have here the indication that growth of economic activity is moderated in the first half of the year. We get that sense. That would be that weak consumption that we just looked at. But interestingly, we get two dissents at this meeting. Governors Chris Waller and Michelle Bowman vote against the consensus. The consensus decides to keep rates unchanged. Bowman and Waller decide that they're going to vote for a cut. What's interesting in this context, of course, is just how telltale that is of a broader shift in the thinking on the FOMC committee. And so minutes from that July meeting, due on Wednesday this week, should be very interesting to see because, needless to say, in the wake of this stage setting, then followed by CPI, the markets talked themselves into believing that the Fed is increasingly on autopilot. If that is not the case, if for Waller and Bowman this was not a massive head change, but instead just a thinking about sequencing and the idea that it takes between 12 to 18 months for a single rate cut to be fully absorbed into the economy, so maybe it doesn't make sense to be overly cute about it, this meeting or that, but to just get on with what will be needed in the economy a year hence, year and a half hence. If it seems like there isn't a broadening dovish consensus to be extrapolated from these dissents, that probably tells the market that the Fed is not nearly as expansive in its thinking as what is currently priced in. Again, the markets are valuing securities from the perspective that there is 117 basis points in rate cuts on the menu. And for the Fed, there's only 75. And then, of course, there is the Jackson Hole Symposium. This is the annual central bank conference that the Fed holds in Jackson Hole, Wyoming. As ever, the main event for the symposium will be Friday's Fed Chair Powell speech. That's a kind of annual lens setting exercise where essentially Powell tells investors, or whoever the Fed chair is tells investors, how to think about valuing the trajectory for policy a year forward. It basically establishes for the markets the sort of academic and tactical lens through which the Fed is looking for the year ahead, so that Fed watchers, markets, of course, front and center, can take in information, incoming economic data, incoming headlines, filter them through what they then believe the Fed's thinking is, the sort of overall structure of how the Fed considers the way forward, and see if they can then come up with expectations that approximate what the Fed might actually do. If that stage-setting exercise does not give us the dovish conviction that investors want, if it does not set us up to come in September, not just with a rate cut, which again is widely expected despite some diluting of the chances here, and if what comes of it, that September meeting, is not a meaningful revision of this into a more dovish direction, well, then perhaps the markets are not going to have the confidence that they've been having about the idea that the Fed is coming to their rescue and will avert an economic downturn before it really gets to be a dangerous sort of thing. And if that's the case, well, then the markets perhaps have some room for a pullback from these levels, because then perhaps we've arrived at the idea that with the U.S. clearly cooling, as even the Fed has recognized, with consumption, which is 68% of overall GDP, now contributing a pittance, and with the inflation dynamics here, again, as surmised by this consumer confidence data, and as telegraphed in this PPI data, as well as now this slight angling beginning to seep into CPI, if that's going to give us a consumer that's more reluctant, if consumption then continues to weaken into the third and fourth quarters, even as the Fed is worried about the inflation piece and holding back from the kind of stimulus that would actually push back on these dynamics in a timely fashion, well, then perhaps the markets will reason that assets are just too expensive for a rosy, soft landing kind of a view. And where the likelier scenario is that the Fed is going to have to do some catch-up cutting because it will have allowed the economy to weaken more than is optimal. And of course, the tricky thing with recessions is they are non-linear. So once you've missed the opportunity, there's no telling what might end up at the bottom of the pool once you start to drain it. If a recession, even a very mild one, were to strike, all manner of knock-on effects become possible. So when we look at the way that the markets are likely to treat this week and in the way that they've approached last week, when there is something dovish or could be painted as dovish, the markets seem to be in generally good spirits. Absent immediate fodder fueling that idea, they are at best listless. And if the commentary this week from the FOMC minutes and from Powell ends up looking less than the perfect dovish world that the markets would love to see, well, then the markets, at least for the equity space, appear to be somewhat soggy in their positioning and might end up slipping. That, of course, is likely to have knock-on effects on bonds and the dollar, where haven demand might prevail. And we'll see what it does for crude oil and gold. And if it manages to engender some directional conviction there, finally. With that, we have macro money for today. We are, of course, here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Chris and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
My most controversial market opinion is it's probably more political.
What's your most controversial market opinion right now?
My most controversial market opinion is that I shouldn't be following Mike and Nick. Just kidding. Love you guys so much.
The hottest take of this market? I gotta think about that. I don't know. I do like to trade the leverage, but that's not controversial. I don't know what controversy means these days. Like, I don't know. I'm sitting on cash. Like, I'm still sitting on a lot of cash, and I think that's generally seen as like frowned upon, but like I'm still doing it. I know market's been bouncing back up. I know things have been looking clear, but no, trust issues.
I honestly don't know if I have one. I'll say the fact that I like to trade earnings or direction as opposed to vol.
My most controversial market opinion is it's probably more political than it is anything else. So, I would say that, unlike others, I think the current political environment in this country is dangerous for the long term.
Dear Kaylee, hats off to you for being such a culinary genius. I don't think it has ever dawned on our kitchen staff to serve gazpacho hot. Sincerely, Bob.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't want to fact check you with my vagina, but I will.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap. I'm sitting at my desk, so I wear my AirPods in most of the time. And I guess he was bellowing at me, and I didn't hear him.
I wouldn't call it bellowing.
Gus said that you were bellowing at me. So I'm sitting at my desk. I get a text message from Tom, and all it says is, "Where is this chair from?" So he was yelling my name across the office. I didn't hear him. He sends me a text message, and I write back, "Bitch, this ain't Chat GPT." And so back, I proceed to use technology to find it for him. And so then he complains to me about what the price is. As if I had set the price, and he was like, "Well, how much did I pay for it originally?" As if I would know.
But a helicopter, not my thing. I'll take another means of transportation.
Okay, all right. I don't want to take a helicopter too, but an electric helicopter with...
That's better?
I think so. I like the four little things as
four things.
One big...
The four little things. Oh my God, you're so cute, Sosnoff. I'm serious.
Wait, did you get the twirl?
We're going to the opening night now.
We are 50-yard line.
Oh, you guys are going to another party together. Oh, am I just driving you there?
If you could, that'd be nice.
Be nice.
The best part.
You need to be picked up too?
I hope you're not mad, but I was hoping after work that day you could drop us off.
Of course.
See, because the reason we need to get there early is because we got to start the tailgating on the balcony early because we're going on the field most likely before the game.
You're going on the field most likely before the game.
Might have an invite.
We might have an invite with somebody special.
I'm working at it.
You guys are special, indeed. You guys are really special.
It's so annoying.
Oof. You guys are going to hold hands tomorrow before we start the show.
We're going to take a quick 90-second break and come back. We got more Tasty Live after
We're already out.
No, you're not.
Oh, we're not?
God, you're really good at this. You're really good at this.
Get the full scoop by checking out the archives at tastylive.com.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and with me today, of course, Dan Cecilia, and special guest, Stephen McIntosh from Mill City Ventures. Stephen, welcome to the show.
Thank you. Great to be here.
It's great to have you here. We're excited to talk to you. Certainly given everything that's going on in the market with a lot of treasury companies being spun up. We're going to talk about that in just a second. But before we do, can you give us a little bit of background on yourself as well as the inception of Mill City Ventures, and then we'll get into all the details here as to what you guys are doing and kind of what you're seeing in the marketplace.
Yeah, sure. So I'm Stephen McIntosh, co-founder of Heritage, which is a proprietary hedge fund. We invest in deep tech and crypto. We've been investing in the space for a number of years. We originally got connected with Gavin and Vitalik when they were at Ethereum in 2016. We were early investors in the Polkadot ecosystem, in the Solana ecosystem, right the way through to Sui, Miston Labs, and most recently payments-focused blockchains like Plasma in conjunction with Tether. And we've really invested across the stack from the consumer level, like Pump.Phone, right through to fully homomorphic encryption, right through to security companies, right through to centralized exchanges, decentralized exchanges, and everything you can kind of imagine. We've also been very, I think, strong backers of early stage managers in the crypto industry. We've backed about 16 different hedge funds and VC funds, often anchoring them to get them to explore new kind of verticals, whether it's DeFi, gaming, security. So we've got a really broad portfolio. We've seen everything crypto has to offer over the years. And yeah, we've been a prolific investor in the Sui ecosystem. Delighted to have joined that team at the beginning of their journey and have invested in a number of companies that have come out of that ecosystem over the past few years, from DeepBook to Walrus to DoubleUp to Shio, SuiLend, and many others we can talk about in the show. But we think this is a generational opportunity. We think it's the most important blockchain to custody in a public treasury strategy. And I'd love to get into what makes Sui unique on this show today.
Yeah, well, I guess let's just jump right in and start there. Mill City Ventures, ticker symbol is MCVT, VT or TV? Sorry.
VT.
VT. Apologies. Okay. You've recently spun this up, right? And there's $450 million in the treasury company. You've been in the space for a while. What is it about Sui that has your attention?
So I think it's good to go back to the beginning of where this company came from. This is the team that was hand-selected by Mark Zuckerberg to build the Libra and Diem crypto projects. And as you can see in the recent press around the war for AI talent, Zuckerberg hires the best, he pays the most, and he's very competitive when it comes to world-class talent. And he hand-chose these individuals. The 5 founders that are at Miston Labs are the highest intellectual capital in crypto. And it's important to stress that when Zuckerberg kind of started those initiatives, he was looking to roll this out to 3 billion users at the time. And I think that's a really important starting point. And had that company been allowed to succeed in their crypto project, which was prevented by the previous administration and SEC regime, that could have probably been the biggest business in crypto, bigger than Tether, bigger than Coinbase. I think that's highly likely given the distribution and the intellectual capital that came out of that team. Whilst they were there, Sam Blackshear invented Move, the only smart contract focused programming language that's designed for crypto that has security by design. The Move kind of base programming language is super unique, this object-oriented data model that allows for a lot of unique programmability. The consensus mechanisms that are placed in Sui, from Narwhal now to Mr. SETI, allows for incredibly fast finality on the network. And it is a truly universal coordination layer for the internet of the future. If we think about the types of experiences that have been we've been so accustomed to in Web 2, social media, gaming, they have been prevented from flourishing in Web 3 because of the underlying infrastructure. And Sui is designed to solve that. It's designed to onboard the next billion users. And we think it's not a question of if, but when a breakout use case emerges in the next couple of months or the next year, which will have hundreds of millions of users. And if we think about what the future represents in terms of these huge driving technology forces in AI, and stablecoins, you need a network that can handle trillions of dollars of payments flow. And you also need a network that can handle agentic actions that are probably emitting billions of events at the same time concurrently. And I think it's been proven through the statistics that are coming out of SUI at the moment that it's got all-time transaction volume, on the network. It's got incredibly high number of users joining the network. It's got a really huge growth in TVL. And in the past year, I think according to the latest Electric Developer Capital report, it had the fastest growth in developers of any ecosystem. So you can see that all the numbers are pointing in the right direction. SUI is only 2.5 years old on mainnet, but the velocity of growth of this ecosystem has been extreme. And I think we as investors at Caritage have underwritten that growth from the very beginning. I think what's come out of the SUI ecosystem has been profound. They've got programmable storage in Walrus. They've got this really important center of liquidity in Deepbook, which is kind of the on-chain NASDAQ that underpins many things together on SUI. They have now these incredible acquisition and onboarding technologies from ZK login to passkeys that came out in the past few weeks, which allows anyone to create a wallet seamlessly using biometrics or using Google single sign-on. These are the types of enabling capabilities that will allow breakout use cases to emerge in SUI in the next year or so.
What do you think some of those potential use cases are? Is this more DeFi oriented? Is it gaming? You've mentioned AI and agents. Kind of how do you see this playing out?
I think it's all of the above. I think, what's great about SUI is it is a universal coordination layer. And, the types of experiences that, require hundreds of millions of users, billions and trillions of transactions, they can only really be enabled by SUI. And I think that many analysts and many technology commentators and reporters have kind of come to that conclusion recently. I think the consensus algorithm is novel and unique and has been proven to have this very specific kind of fast path consensus mechanism, which allows for really fast finality and high throughput. Similarly, the very kind of essence of the move-based programming language allows for programmable transaction blocks. It allows for inherent concurrent scalability, so you can handle transactions simultaneously and not be prevented from dealing with sequential transaction ordering that you see on an account-based model that's typical with Ethereum and Solana. So I think SUI is a very important and new technology paradigm that will enable hopefully use cases we've never seen before. I think what you mentioned, payments, DeFi, gaming, sure, agentic experiences, they all, I think, will flourish on SUI. And just for everyone's kind of benefit, I used to be in the AI industry, previously was chief commercial officer of a company that was started in the UCL AI Research Lab alongside DeepMind, and we ultimately exited that business to a New York Stock Exchange listed acquirer. I'm very familiar with the event workload that is emitted when individuals or kind of businesses, make requests on these ML infrastructures. The types of transactions that are coming through, the scale of that is so significant, and you can see that in a lot of the reporting around how much GPU, how much compute is required to scale AI every 6 months, every year. It's just growing exponentially, and you need a network that can handle that throughput. And right now, I think SUI is totally unique as a technology in being future-proof. One last comment is that there's a huge existential threat to crypto networks in the form of quantum computing. And if you look at the research that came out of SUI recently from the chief cryptographer, Kostas, who incidentally was the head of cryptography for WhatsApp, for Instagram, which had billions of users. He's just released some really groundbreaking research on post-quantum security in EDDSA chains. And you can see that SUI is really building for the future. So that's how I would answer your question. It's set for every type of use case, and it doesn't, necessarily have to be pigeonholed into one certain sector.
Awesome. So, you guys are obviously making over at Mill City Ventures a considerable investment in the space. I'm curious to kind of learn a little bit more about the strategy, but before we jump into that, this is clearly a trend here. We've seen this support a lot of different assets, and what I mean by this is the treasury companies that have been spun up. We've seen those for Bitcoin, obviously, with probably Strategy being the first and most well-known. We've seen this with Ethereum. I've seen a couple others mentioned with BitTensor, purchasing Tau, Sui. What is it about the treasury companies that is attractive to investors? What's the reason for those?
I think that we are at a tipping point in crypto's history. I think that what Saylor has done in MicroStrategy and what the Circle IPO proved this year is that there's an explosion of latent demand for crypto equities, equities that have some kind of crypto adjacency, right? Even in Robinhood, for example. And institutional appetite has been pent up for a while because of an unclear regulatory environment. And I'm here from the SALT conference in Wyoming, where the chairman of the SEC will be speaking alongside Cynthia Lummis and many other members of Congress who are part of the pro-crypto administration and pro-crypto Congress that are really pioneering a new future for our industry. And I think it's incredible how all of these different things are coming together. I think in regard to institutions, many are getting up the curve in terms of custody and security for how to actually own the underlying assets, but not every institution's there yet. And it requires, personnel, human capital, insurance, and policy change to actually purchase spot assets. And so what DATs offer investors is a safe and compliant equity wrapper to access the explosive growth of a new network like SUI. I think that, as you can see in some of the high-profile names that are coming into the DAT space, it's multi-strat hedge funds. It's even the likes of Fidelity and others are coming in now to these DATs. The investor base is transforming right before our eyes, and I think the U.S. capital markets are so unique. The liquidity there is not like anything we've ever seen in crypto. And you can definitely create generational companies like what Michael Saylor has achieved with MicroStrategy. He's done such a great job at educating Wall Street on the compounding effects of Bitcoin. And now we have access to these next generation technologies in the form of SUI, that, as I say, came from Facebook, where probably could have been the biggest business in crypto in the world, and are now being able to flourish in an unrestricted way through SUI, through the SUI ecosystem. So many investors are very interested in the technology progress of this sector. Many investors and analysts think about the growth of the internet in the 2000s and how it created companies like Facebook and Google. And I think for us as investors, and for many of the investors who joined our pipe round, who were disclosed in our press release, they see this as the opportunity to get access to one of the most important generational companies in crypto. And then you also back a management team to deliver a dynamic strategy. So, our job is to accumulate SUI in the market in a dynamic strategy that drives return for our shareholders. Second, we will provide economic security to the network in the form of staking and potentially also running our own validator. We'll return that yield back to investors in the form of SUI per share. And then in the medium term, we actually want to be a really important actor in the SUI ecosystem. We, as I mentioned, at Caritage have been one of the most prolific investors in this ecosystem. We think that it's an incredible community, and we want to drive not just economic security, but the growth, the value of SUI, and we want to drive that community. So we think our balance sheet can play a very interesting role in providing liquidity into growing SUI DeFi and other aspects of the SUI ecosystem. And then we will provide that return back to shareholders in the form of SUI per share. So it's all about driving a dynamic return being value accretive in the form of SUI per share, and having a competitive strategy that's most importantly backed by the SUI Foundation. And we brought this to market in partnership with SUI. We were both the lead investors, and we did something that was disproportionate in the DAT space. We locked our shares for 12 months to prove to our shareholders and to the SUI community that we are long-term focused. This is not opportunism. It's not a trade. We're here to build the SUI ecosystem long-term and drive the value of SUI.
Yeah, I want to dig into that because that all it makes sense. Why you guys are different and what you're doing specifically within the SUI ecosystem. You spoke about projects like Walrus. You spoke about projects like SUI Lend. I'm big on SUI Lend and was in Walrus. I'm just wondering, are there anything other projects that come to top of mind that you'd be looking to back as one of the main, funds for SUI? So is there anything like crypto AI you mentioned before? Just anything that is on the horizon for the SUI ecosystem that you would either like to see or that you could potentially, back?
Yeah, so I think the most important answer that I would say is that Bitcoin on SUI is driving a lot of investor appetite right now. We think that the opportunity to have Bitcoin natively on SUI at real scale in the next few years is going to be extremely exciting. I think, a small percentage of all Bitcoin is wrapped. Institutions, individuals don't want to take bridging risk. They don't want to take synthetic risk on their Bitcoin. We're seeing very interesting innovations coming from both the external SUI ecosystem, like ICA, which was announced recently, that has kind of come up with some very novel 2PC, MPC technology, which allows for kind of, a much more secure way to get financing on your Bitcoin without bridging it. Similarly, there are some very interesting initiatives coming out of the SUI team and the Miston team itself related to BTC-Fi on SUI in the next couple of months. And I think that's going to be a very exciting part of the growth story. In our investor docs, we actually have the ability to custody both SUI and Bitcoin. And we expect to play a really interesting role in the growth of Bitcoin yield on SUI in the future.
And Stephen, what is the reason for that, where you're seeing demand for Bitcoin on SUI? Is it that it's used as collateral to finance participation or other operations in some way, or where does that demand come from?
I think that yield on Bitcoin is kind of like the holy grail, right? Everyone has been, accustomed to the compounding value of owning Bitcoin and not selling it. But ultimately, it's a very important asset to get liquidity against and to get, to mint stablecoins against. And I think the growth of BTC-Fi could be transformational for crypto. You need a way to handle those assets in a secure and safe way that minimizes bridging risk. I think that the unique qualities of the Move programming language, this ability to have objects at the core of the data model rather than accounts, allows for very unique programmability opportunities. And similarly, coming out of Miston Labs, as I mentioned, kind of Costas before, the chief cryptographer, not only are they researching kind of tracks related to post-quantum security, they're also looking at areas related to AI and to Bitcoin. And I think what will come out in the next couple of months is going to be very, very exciting. I think, stay tuned to Twitter and to Korea Blockchain Week and other events where SUI is going to be present to follow that. But I think that, the overall growth of liquidity that could bring to the whole of crypto and not least the SUI ecosystem could be gigantic.
Where do you see this going long term? I mean, obviously you guys are in it for the long term, given the lockup period. And again, very sizable investment here relative to even the market cap of SUI today, which I think is probably close to 12 billion, maybe a little bit more at the current prices. For anybody that's not in the space or isn't even familiar with SUI, how do you think about it? Is this something that I suppose could reach the market cap over time, assuming this all goes up, of something like Solana today, where you have a roughly $100 billion market cap? And maybe I'm kind of just grasping here, but how do you guys think about valuations long-term in this space. We've got maybe 3 to 4 trillion. I don't know what the exact number is in terms of total crypto market cap today. But as this plays out, 5+ years, and where do you see this going?
I think that we are witnessing an exponential growth of crypto right now. The network effects are truly starting to kind of hit that J-curve. And one blockchain stands out amongst the rest for enabling these billion user type experiences, and that's Siri, right? It's 2 and a bit years old on mainnet. It reached an all-time high of FTV around 50 billion. Solana's 5 years old and has done extremely well, but do I think Sui could outperform Solana within the next year? Definitely. Do I think that Sui could outperform Ethereum in the next 2 years, 2 to 3 years? Definitely, because once you've landed the breakout use cases, the types of experiences that have transformed Web2, the TikToks, the YouTubes, the gaming experiences, once they land on Sui, I think we're set for a very different future. And as I mentioned, if you really think about, agentic experiences, what does that mean? It means AI wallets that can think and act for you. It means like going from an LLM query to an action somewhere in an IT real estate or on a blockchain, right? Like that type of coordination layer is going to be handling billions, if not trillions of dollars of events. I remember back in my previous life when we used to kind of convert unstructured communications data into structured data, and we'd emit those kind of those conversions into structured data via a JSON format in the API, and then that would be fed into a Kafka stream, which could be enabled in the broader IT real estate, whether it was Murex or Salesforce or ServiceNow, to take action on those events. ChatGPT's drawing on upon, I think, like 700 million weekly active users. Just imagine the load that would be required if every one of those users emitted a request at the same time or 10 requests in the same minute. What blockchain can handle that scale? And I think the answer is Siri, right? So in the future, I think the growth of the ecosystem could be incredible, and I think that we are underwriting the exponential growth of Sui in this public company. That's definitely the investment thesis.
Makes sense, yeah. And just real quick, we got a couple minutes left. I'm just curious, like, where do you think the crypto treasury market is going from here? And then specifically, what's top of mind for you at Mill City Ventures? How are you going to manage the sweet treasury, and what's kind of top of mind there for you?
I think the DAT space is a really interesting phenomenon. I think it's unlocking U.S. capital markets liquidity in a really profound and meaningful way that could create generational companies like we've seen with Michael Saylor and MicroStrategy. I think that it could also change the commercial destiny of many of these protocols. In us at Mill City Ventures, we have an executive team that's highly commercial. We've got a great asset manager at Galaxy. And we are mandated to drive investor and shareholder return. And we also have an operating company, remember, inside the business, which is a non-bank financial lender. And so we see the role that we will play in the public markets as driving the value of Sui, driving the vision of Sui, but driving operating return and shareholder return, right, in our stock. And we are, I think, enabled to do things in the market that a foundation can't do, doesn't want to be seen to be doing. And that commercial mandate is limitless. I think, in many ways, what we could become longer term is kind of like a quasi-Sui bank, build we can go into those industries, look for targets, look for companies that have hundreds of millions of users, hundreds of millions of dollars of cash flow, and look to potentially, acquire them or bring them over to Sui in some way. There's a really limitless future of opportunities that we can pursue. But I think what will stand out from the competitive bench is are you coming to market with a foundation? We looked at the DAT space at the beginning of the year as investors at Heritage. We DD'd pretty much every company, and what was missing for us was a DAT strategy that had come to market in direct partnership with a foundation. And what would that mean? Like, what would that mean if you had an exclusive right to purchase tokens from the foundation at a discount you negotiated for your shareholders? What would that mean if you could join in media and marketing initiatives with the actual founders of the technology themselves? What does it mean when you're directionally aligned for the next decade? And how can you leverage each other's expertise and not just provide, as I said, economic security to the network, but commercial growth longer term for this ecosystem? That's a really exciting future, and we do it in maximum respect for the founders of this technology. We aspire to be great custodians of their brand in the public markets, and we really aim to try and grow the value of this ecosystem, the value of this token, and the value of our stock for our shareholders. So I think it's a united vision with the founders, and it's all based on success.
Well, Stephen, we're super excited to see what's next for Mill City Ventures. Again, ticker symbol is MCVT for anybody that wants to check it out. But thank you for coming on the show. Before we let you go, where can everyone learn a little bit more about Mill City Ventures, or even follow you if you're on Twitter, learn more about you? Where can they go?
Yeah, so please follow me on Twitter or on LinkedIn, and please go to our website and to our Twitter page. We'll be publishing all of our SUI holdings and how we've acquired that SUI dynamically in the market every week. We aim to be super transparent, so all of our investors and our kind of community members can follow our journey and be a part of it.
Awesome. Well, it's been a pleasure, and thanks again for coming on the show this evening.
You're welcome. Thank you all.
That's going to do it for our show. We'll be back on Wednesday. Until then, I'm Ryan.
I'm Dan.
Peace.